So my base case is that the cycle's still in place, but that the cycles are changing over time. As Bitcoin becomes a larger market, so it's a larger, more liquid. We're talking a $2 trillion market now. It's more integrated with the traditional finance system rather than almost entirely disconnected from it as it used to be. I do think that some of the extremes are being removed from it. It's easier for a tiny illiquid asset to have extreme price moves than a larger and more liquid and widely held asset. And so I'm not surprised to see that this cycle is more prolonged. But so far, I think it's on track. I mean, it continues to follow global liquidity measures as we'd expect. So my base case is that the cycle's still in place, but that the cycles are changing over time. Even before this cycle, I published research kind of arguing that Bitcoin has correlated more closely with liquidity than anything else. And going back several years, liquidity cycles on average are about 3 years. And Bitcoin's bull markets, even though there's been like one bull market per 4-year halving cycle, the length of those bull markets varies. Sometimes it goes from lows to highs very quickly. Other times it takes longer. And that length of time is actually kind of correlated with what's going on with liquidity for the most part. And as Bitcoin becomes a larger market, so it's a larger, more liquid. We're talking a $2 trillion market now. It's more integrated with the traditional finance system rather than almost entirely disconnected from it as it used to be. I do think that some of the extremes are being removed from it. It's easier for a tiny illiquid asset to have extreme price moves than a larger and more liquid and widely held asset. And so I'm not surprised to see that this cycle is more prolonged. But so far, I think it's on track. I mean, it continues to follow global liquidity measures as we'd expect. I do think that the 4-year halving cycle is increasingly less relevant because mining rewards are now a much smaller share of available coins. And instead, it's mostly about what price will unlock older coins. And so kind of the metrics that I track are one, the market value to on-chain cost basis to kind of see, how much euphoria is in the market at a given time. And then I also track like the HODL waves. So generally speaking, when you have bull markets, the percentage of coins that haven't moved in more than a year or two starts to fall because some of those older coin holders that are deeply in the money now, they tend to start trimming into that strength. And we've been seeing it this cycle, just like past cycles. So I think the those cycles continue to matter, even as maybe the halving cycle matters a lot less than it used to.
Do you think we already reached the peak of this cycle, or you think there is still room to go?
So my personal opinion is we've not peaked yet. And going back to the prior kind of metric that I mentioned, market value compared to on-chain cost basis, the reason that's useful is you can picture, say, a house, like a street with like 50 houses on it. And let's say none of those houses changed hands in a while, and then someone buys one of those houses at a much higher price than it sold for last time. Generally, what will happen is all houses on that street will go up in perceived price because one of their comparable sales changed. And yet a very small percentage of the houses changed hands at that new price. And so that's kind of in a liquid price. It's unclear what would happen if multiple people on that street, wanted to sell their house. And so not until you kind of are at that new price level for a while and there are multiple house sales, would you kind of consider that the new true price of houses on that street. And Bitcoin is obviously much more liquid than that, but it does a similar dynamic where if it jumps very quickly with a pretty small number of coins that kind of changed hands and now we kind of reset the price of the entire market cap, that's not necessarily the real price if more coins want to move. And so that's why I look at the market value compared to on-chain cost basis, because when that gets really far ahead of itself, you're more likely to get a correction. And in the prior major cycle tops, including 2021, that ratio reached extreme levels. So basically, the market value increased way faster than the on-chain cost basis, and then it took a lot of time for that to be digested. When we look at this cycle, we've not reached anywhere near those prior peaks of metrics like that. We've kind of reached, say, mid-levels of that metric. And none of the metrics so far show anything of extreme sentiment like we see at prior cycle peaks, including 2021.
A lot of people might think that this is a sort of political premium that Bitcoin is enjoying at the moment. Do you believe that this premium exists? And if so, don't you think that it is not necessarily a sustainable premium?
I would view it as the opposite. It de-risked it slightly. So it took away a discount. And so basically, when people and institutions invest in Bitcoin, they're pricing in some non-zero tail risk that the government's really going to crack down on it at some point. It's even in recent years under the Biden administration, it's kind of been at the periphery of the market. In order to get the spot ETFs in place, literally the SEC had to be sued, and banks have been very restricted in what they can do with it. And I think the market correctly saw that in this current administration, that's less likely to happen. So they priced out a discount that was in. Now, obviously, in 3.5 years, some of that could be reversed based on election outcomes. That's a pretty far time away. And also, the bigger and more liquid the asset gets, the less relevant governments are for managing it, because at that point, the donors own it, the banks own it, it's tied in the financial system. So every kind of 4 years you give it to keep growing, makes it so the next 4 years kind of matters less from a political standpoint. So I'm not really worried about there being a political premium in it, even though obviously the election outcomes do matter for the asset class. But basically, it's the idea that U.S. fiscal deficits are pretty intractable. And so regardless of election outcomes, because I've saying this before and after the election, there's very few ways to meaningfully reduce the deficit in any sort of investable time horizon, so call it 5 to 10 years. And therefore, I had the view that this is going to be very persistent, and therefore the market impacts from those deficits are likely to continue. So the main metrics I look at, one of them is demographics. So as the baby boomers started entering retirement years in the late 2010s at scale, there started to be a drawdown of Social Security, for example. And we started to see a disconnect where normally fiscal deficits are higher during periods of high unemployment, and they're lower during periods of low unemployment. And we got a disconnect from that. So we started to see large deficits even during periods of low unemployment. And so they're disconnected from the economic cycle because they're more tied to demographics, more seniors collecting Social Security and Medicare and paying less into the system. And so that's a fundamental change. Another really big fundamental change is the interest rate. And so for about 40 years, there was rising debt to GDP, but there was falling interest rates. And so the interest on that debt, especially as a share of GDP, was very manageable. But then once we hit zero, kind of throughout the 2010s, and we started to have more inflationary pressures. And now, even if we only go sideways in interest rates, so I'm not even necessarily calling for higher interest rates, but if we just kind of bounce around between 2 and 6 for the foreseeable future, instead of going structurally downward, there's no longer an offset to the rising debt to GDP. And so we for the first time in decades, we got to break out in interest expense as a share of GDP. And so that's a very meaningful and intractable issue to deal with. There's multiple other factors. A really big one is that the U.S. is more financialized than many other developed countries, meaning that our tax receipts are heavily correlated with our stock prices. So if we get like a bad or even a mediocre year in the stock market, with a lag, like the next year, generally speaking, tax receipts are not very good. And that's for a couple of reasons. One, we have more wealth concentration than most other developed countries. There's more global capital stuffed into our stock market. We have, a lot of compensation is tied to stock prices, especially among high income, which pays the majority of taxes, and of course, capital gains. So all these factors together makes that pretty strong correlation. So that means even when they do try austerity in some way, like they try to trim spending or try to increase taxes, it's likely not to it's likely to translate to kind of worse stock performance, which then ricochets back and hurts your tax receipts. So basically where they are, this whole debt cycle, where they are in demographics, and then the highly polarized Congress that kind of makes major tax increases hard and makes major spending cuts hard. A lot of this is just locked in almost regardless of election outcomes. And so for the next 5-10 years, I think this is going to be a background issue that both in terms of the economy and in terms of capital markets will be relevant. And of course, Bitcoin, the reason Bitcoiners should pay attention to it is because the main competition of Bitcoin is the dollar. And so if the dollar is very strong, then it makes the case to own it. But if the dollar, if total credit in the system and total dollars in the system are going to keep increasing over the next 3, 5, 7, 10 years, that's one of the macro factors that makes Bitcoin useful to own. You want to own scarce assets if you're in kind of a slow motion runaway fiscal spiral. Bitcoin, gold, high quality equities priced at reasonable valuations, high quality real estate priced at reasonable valuations. Generally speaking, I like the global assets the best. So that's Bitcoin and gold. And between the two, Bitcoin's the faster horse by far.
What if are we underestimating the resilience of the fiat system? What if, for example, technology could come into play with technological deflation? So when technology improves, things get cheaper. Wouldn't that invert the trend you're talking about?
It's not going to slow down the deficits. Technology does have other impacts on, for example, where inflation shows up from those deficits. If you don't get a lot of technology offsets, then those deficits are likely to show up in consumer price inflation. So, for example, if we're not better at making more energy, if we're not better at making more productive things related to AI and things like that, then those deficits are likely to show up in price increases because our supply is not keeping up. On the other hand, if AI suppresses white collar wages, allows way more white collar output for things, and if we keep the energy flowing and things like that, then those fiscal deficits are more likely to show up in asset price inflation. And so either way, if the number of dollars is increasing substantially, you want to own the highest quality scarce assets. So if for example we have no bottlenecks in energy, it doesn't necessarily follow that oil is going to go up in dollar terms, even though there's a lot more dollars, say 5 years from now, than there are now. On the other hand, if that's happening, we're not making more Bitcoin other than the marginal amount that's still being mined. And so the highest quality assets, whether it's Bitcoin, gold, the best equities, best real estate, the best, irreplaceable art, waterfront property, those types of things, they're still likely going to appreciate relative to dollars in that system where total credit keeps growing. That whole structure is almost disconnected from technology. And so technology just kind of shows up where that price increases are likely to happen.
And now, final question, Lyn. I want to know your price outlook for the next few months. Do you have some price targets that you're looking at in terms of how higher we can go from here in terms of Bitcoin price?
I think it'd be disappointing if we don't see at least 150K. I'm hesitant to give a much higher price targets because you could certainly reach there, but I try to take, one step at a time. And so I think that by most metrics, I'd be surprised if we don't see another 30+% move or more that would get us up to that kind of that higher level. There are certainly higher numbers that I wouldn't be surprised at all. I'll reassess if we reach those numbers to see if there's still more to go. But basically, I think we're in a longer cycle, maybe less extreme, but still, summers and winters, still bull markets and bear markets. And I tie them less to the 4-year halving cycle and more toward pockets of euphoria, pockets of depression, as well as the supply demand cycle. So what kind of higher prices unlock older coins and what kind of consolidations stop those older coins from getting to the market? I'd say most metrics suggest higher from here, at least moderately.
Welcome to the deep dive. This is episode 34 of the Market Chronicles. Really glad you could join us. And hey, if you're watching over on YouTube, definitely hit that subscribe button. You won't want to miss what we've got coming up. Today, our mission really is to cut through some of the noise. We're going deep on the latest insights from market analyst Lyn Alden, specifically looking at Bitcoin, how its landscape is kind of shifting, and importantly, how it fits into those wider macro financial trends we're all watching. Think of this as, your shortcut to getting properly informed, getting that edge.
Absolutely. And we're not just skimming the surface here. We're really digging into her key perspectives on Bitcoin cycles, how it's integrating more with TradFi, and also the impact of these really big global economic factors like, the U.S. fiscal deficits that just keep rolling. The idea is to help you connect these dots, right? To make sense of what can seem like pretty complex market dynamics and hopefully see that bigger picture a bit clearer.
Okay, so let's start with Lyn Alden's core view on Bitcoin cycles. Her base case seems pretty straightforward. Cycles are still a thing, definitely, but they're changing.
Right. And the key insight really is that Bitcoin isn't just this niche asset anymore. It's matured. We're
Yeah.
talking about a much larger, around a $2 trillion market now. It's more liquid. And it's increasingly tangled up with traditional finance. That's a huge shift from its past.
And that maturity, that size and liquidity, it's changing the behavior, right?
Exactly. It's removing some of those really extreme, like vertical price moves we saw back in the day. An illiquid asset, well, it's just much easier to push around, up or down. Now that Bitcoin's bigger, more widely held, those big swings, they seem to be getting sort of stretched out, more prolonged cycles overall.
Makes sense. And Alden connects this to liquidity too, doesn't she?
She does, yeah. Her research really highlights this strong correlation between Bitcoin and global liquidity measures. These liquidity cycles, they tend to average about, 3 years or so? And often, the length of Bitcoin's bull runs seems to kind of line up with these liquidity shifts.
Interesting. So it's maybe less about the 4-year halving cycle now? I know a lot of people focus on that.
Well, yeah, Alden suggests its direct importance is actually fading a bit. The reason being, the mining rewards, the new coins coming online, they're just a much smaller fraction of the total available Bitcoin compared to, say, 2012 or 2016.
Right, the inflation rate keeps dropping.
Exactly. So the focus is shifting. It's less about the halving event itself and more about what price levels are needed to kind of unlock those older coins. At what point do the long-term holders, the ones sitting on big gains, decide, okay, maybe it's time to sell a bit?
That's a really key distinction. So how does she actually track this? The sentiment, the supply dynamics?
She looks at a few specific on-chain metrics. One big one is the market value to on-chain cost basis, the MVRV ratio. That helps get a sense of like the overall euphoria or profit level baked into the market.
MVRV, got it. What else?
Another really telling one is HODL waves.
Ah, yes, HODL waves. That tracks how long coins have been sitting still, right? Like the percentage not moved in a year or 2 years.
Precisely. And what you typically see in bull markets, and Alden points this out, is that the percentage of these older coins starts to drop. Why? Because those long-term holders start to trim into strength. They sell off a bit as prices climb. And we've been seeing that pattern play out again this cycle.
Okay, so that leads us to the $1 million question, or maybe the $100,000 question these days. Has Bitcoin already peaked for this cycle?
Right. And Lyn Alden's personal take, based on all this analysis, is pretty direct. She says, we've not peaked yet.
Okay, bold statement. Given, the run-up we saw earlier and the subsequent chop, what's the reasoning there? How does she back that up against maybe common assumptions?
Well, the rationale is quite interesting, especially looking at that MVRV metric. Again, she uses this analogy like house prices on a street. Imagine one house sells for way, way higher than anything before.
Okay.
Does that immediately mean every house on the street is worth that much? Well, technically, maybe the perceived value goes up. But only a tiny fraction of the houses actually changed hands at that new price.
Yeah.
It's kind of an illiquid price point until more transactions happen there, confirming it.
Right. You need volume to validate the level.
Exactly. And her point for Bitcoin is, unlike previous major cycle tops, like back in 2021 even, the current MVRV levels and other similar metrics, they just haven't hit those extreme euphoria readings. They're more at what she calls mid-levels. They're elevated, sure, but not showing the kind of widespread extreme froth you usually see right at a major peak.
Interesting. Okay, shifting gears a bit. Alden has this kind of counterintuitive take on politics and Bitcoin's price. Not a political premium, but something else.
Yeah, she flips it. She argues it's not really a premium being added lately because of, say, ETF approvals or regulatory clarity. It's more the removal of a discount that was already priced in.
A discount. What was the discount for?
Basically, the risk of a major government crackdown. Historically, she argues, investors, especially institutions, priced in this, non-zero chance that governments might try to severely restrict or even ban Bitcoin. Think about how long and difficult the process was just to get the spot ETFs approved. The SEC had to essentially be sued into it.
True. And the banking restrictions that have been in place?
Right. So Alden suggests the market looked at the current environment, maybe the current administration's stance, and perceived a lower chance of that kind of aggressive crackdown happening now. So that risk factor, that discount, got reduced or removed, allowing the price to reflect maybe a more neutral political outlook.
So the market's just catching up to a slightly less hostile perceived reality. But, couldn't things change? What about future risks, like, say, a big digital asset tax? Could that reintroduce a discount?
It's possible, sure. But Alden's longer-term view is kind of interesting here. She thinks that as Bitcoin gets bigger, more liquid, more integrated, governments actually become, in a way, less relevant in controlling its destiny.
How so? Too big to fail, almost.
Sort of, or maybe too integrated to easily attack without causing other problems. With more institutions involved, more traditional finance players, maybe even more political donors holding Bitcoin, it just becomes harder to single out for really harsh treatment. Its roots go deeper into the financial system over time, making drastic political action less likely, or at least having more pushback.
Okay, that makes sense. Connecting this all to the really big picture now, Alden consistently highlights U.S. fiscal deficits as this massive, persistent macro force. She calls them locked in for the next 5-10 years, almost regardless of who's in charge. But are they really that locked in? Couldn't, say, a different party win or a sudden economic boom change things dramatically?
Well, that's the natural pushback, right? But she lays out a pretty compelling case for why they're so sticky. There are a few key drivers. First, just raw demographics. You've got the baby boomers hitting retirement age en masse.
Right. Social Security, Medicare drawdowns.
Exactly. Big, sustained drawdowns. And this has actually led to a weird situation where we see large deficits even when unemployment is low. They've sort of decoupled from the normal economic cycle. Second, interest rates. This is huge. For like 40 years, rates were generally falling, which helped offset the impact of rising debt levels.
Kept the interest payments manageable, yeah.
Right. But that era is over. Now rates are bouncing around, say, between 2% and 6%.
Yeah.
That downward offset is just gone. So we're seeing interest expense as a share of GDP really starting to break out, climbing significantly for the first time in, well, decades.
That's a major structural change.
It really is. Third, she points to the financialization of the U.S. economy. Tax receipts have become really closely tied to stock market performance. If the market has a flat year or a down year, tax receipts tend to disappoint the following year.
Creating a feedback loop.
Yeah, a kind of financial catch-22. Even if you try austerity measures like cutting spending or raising taxes, if that hurts market performance, it can actually hit your tax receipts too. It's tricky. And finally, just the political reality. Extreme polarization in Congress makes big, sweeping changes. Major tax hikes, major spending cuts, incredibly difficult to pass. So the path of least resistance is often more deficits.
Okay, so if we accept that premise, that deficits are likely to persist and the overall supply of dollars and credit keeps expanding, what does that mean for you, the listener, for investment strategy?
The logical conclusion, according to Alden, is that owning scarce assets becomes really crucial. If the denominator dollars keeps growing, you want assets whose supply doesn't grow as fast or at all.
Like what specifically?
She points to things like Bitcoin, obviously, gold, high-quality equities, but importantly, at reasonable valuations. Same for real estate. She has a particular fondness for what she calls global assets, things not tied to any single country's policies. Bitcoin and gold fit that bill. And between those two, she often refers to Bitcoin as, quote, the faster horse, just given its volatility and potential upside, historically at least.
The faster horse, okay. But what about technology? Couldn't things like AI create massive deflation countering all this? That's an argument you hear a lot.
Yeah, it's a common point. But Alden has a really nuanced take here. She argues technology doesn't really slow down the deficits themselves. The government spending, the debt issuance, that continues. Instead, technology influences where the resulting inflation actually shows up.
How does that work?
Well, think about it. If technology doesn't lead to massive increases in the supply of key things like energy, or maybe overall productivity doesn't boom from AI as much as hoped, then those deficits, that extra money chasing goods and services, it's more likely to show up as higher consumer prices, CPI inflation.
Okay, and the alternative?
The alternative is maybe AI is really good at, say, suppressing white-collar wages or boosting output in certain sectors without broadly lowering consumer prices. In that scenario, the deficits are more likely to flow into and inflate asset prices, stocks, real estate, Bitcoin perhaps.
So either way, inflation happens somewhere.
That's the core takeaway from her perspective. Whether it's consumer prices or asset prices, if the total number of dollars in the system is going up substantially over time, the fundamental strategy doesn't really change. Own the highest quality scarce assets you can find. It's a structure that's almost, as she puts it, disconnected from technology in that sense. The where might change, but the need for scarce assets remains.
It's about that relative scarcity in an expanding monetary base.
Precisely. Preserving purchasing power when the unit of account itself is becoming more abundant.
All right, let's get to the outlook then, the big question. Where does Lyn Alden see Bitcoin's price heading in the, say, coming months or this cycle?
Okay, so she puts a number out there, with caveats, of course. She says she'd be, quote, disappointed if we don't see at least 150K.
150K, wow, okay, that's significantly higher from here.
Yeah, suggesting at least another, 30% move or maybe quite a bit more. She's open to higher numbers, definitely, but she emphasizes taking it one step at a time.
And what about the feel of this cycle? Different from before.
She thinks so. Likely longer and maybe less extreme in terms of the percentage gains compared to the really early cycles. But importantly, still featuring clear bull and bear markets. It's not just up forever. And again, she stresses that the price action now is probably less tied to that predictable 4-year halving rhythm.
Right, more about liquidity and sentiment.
Yeah, and what she calls these pockets of euphoria, pockets of depression. It's also about that supply-demand dynamic. We talked about what price gets the old coins moving, what consolidation levels absorb that selling pressure. But overall, looking at the metrics right now, her assessment is pretty clear. Most metrics suggest higher from here, at least moderately.
Okay, so wrapping this up, that was a really packed deep dive into Lyn Alden's framework. It gives you this comprehensive, quite nuanced way to think about Bitcoin cycles, its connection to TradFi, and the whole macro backdrop. Hopefully it serves as that useful shortcut, helping you feel more informed and providing a solid lens to view the market.
Definitely. And maybe one final thought to leave you with, drawing from all this. Given these persistent global fiscal trends, the deficits, the expanding money supply, and given the unique nature of genuinely scarce assets in that environment, how might your own understanding of what value even means? How might that continue to shift and evolve in the years ahead? Something to chew on.
A great question to ponder. Well, thank you so much for joining us for another deep dive here on the Market Chronicles. We really enjoyed digging into these topics with you. Keep learning, keep questioning, and we'll catch you on the next one.